Hi guys, in today's video we're going to go over what is Bitcoin ETF and why the public is so excited about it. Why this is a big step for the crypto in general and why a lot of institutional investors have changed their thesis. In the beginning they didn't like crypto, now they love it. So first of all, what is Bitcoin futures ETF? Why this is something big? So Bitcoin futures exchange traded funds are pools of Bitcoin related assets offered to traditional exchanges by brokers. Essentially, guys, they don't want you to buy the Bitcoin itself. They want you to buy their ETF, which is the actual paper. It's like when you go and buy S&P 500 index funds, right? You buy ETFs that are related to the index fund. You don't buy the Tesla or the other individual companies inside S&P. You just buy the ETF itself. The intent behind these particular ETFs is to give retail and other investors exposure to the cryptocurrencies without needing to own them. You understand how it works, right? Which is one of the biggest, downsides for people who usually buy on the exchanges crypto, right? Because it's not self-custody. This is why a lot of people have been buying crypto through their own wallets. Key takeaways over here, guys. So Bitcoin futures ETFs are exchange traded funds that aim to mimic the price movement of Bitcoin. So the ETF has its own price that is related in some sense to Bitcoin price, simply because it is not pure Bitcoin. It is a pool of cryptocurrencies inside this ETF, and this is why the price of Bitcoin is not one-to-one with the same ETF product. Okay, this is why when we had the rally in the beginning of this year in S&P 500, when you go through Vanguard or Fidelity different ETFs, each one perform differently, because generally they do have like 80% same stocks inside, but the 5, 6, 7 different stocks that are in between are making the big difference in the performance overall. Also, going back over here, guys, you will see that the ETFs use future contracts to achieve the goal. So it's not stock, right? You're essentially betting on the future contracts for the future prices. Also, guys, you want to see over here that the fund managers purchase these contracts and bundle them into a fund. This is why BlackRock has to have a custodian, right? Has to have someone to hold their Bitcoin when they actually offer their ETF to the clients. So this is how it works. So BlackRock buys, let's say, $1 billion worth of Bitcoin, for example. They have to put this Bitcoin somewhere, right? They put it into Coinbase, for example. Then they create this pool of different crypto products, right? Not only Bitcoin, different crypto products, and everything is linked to the value of the BlackRock ETF. Then they go to the clients and send a, let's say, offer or make a presentation, and they incentivize them to buy into the ETF. So they could be for a variety of reasons: diversification, speculation. These funds gained popularity in part due to the SEC blocking the creation of ETF that directly hold Bitcoin. So this is why they cannot actually hold their Bitcoin. This is why they need a custodian. This is what I mentioned earlier with Coinbase example. Let's understand what is the reason why people would want to buy the Bitcoin futures ETF versus buying the actual Bitcoin, right? What is the motivation behind? So the actual futures through the ETF composed of assets related to Bitcoin price. They're traded on traditional exchanges instead of the cryptocurrency exchanges. So essentially you can go buy probably on New York Stock Exchange or on Nasdaq instead of going on the Coinbase. And this is what they want, right? They want to keep you on the strictly regulated exchange where things are under the control of the SEC, because SEC does not have overhaul on crypto. They do have on the stock market. And when a product like this is traded on the stock market or on the futures market, it still falls under the regulations of the SEC. Currently, the underlying asset with Bitcoin futures ETF. Okay, so these are traded on Chicago Mercantile Exchange. A futures contract is a standardized contract where two parties agree to exchange a specific quantity of assets on a specific day for a specific price. You understand how the futures work, I presume. So let's say, for example, I buy a futures contract for Bitcoin price Christmas 2024 with a price of, let's say, 100,000, right? The idea over here is that you pay a premium for this contract, but essentially you're betting over there when you buy the contract, right? Somebody at this point, if the prices of the Bitcoin are actually above the 100, let's say 150,000, you still have the future contract that you are able to exercise, and you're able to buy the Bitcoin if you really want to do that at 100,000. And the person who sold the contract to you, they have to buy on the open market, and they have to sell to you at 100,000 below market. So this is the risk associated with selling contracts, right? And there is a risk associated with buying. Of course, it might be lower. Just think about Christmas and Bitcoin is still at 50,000, but you have a contract with 100,000. So essentially, you lost a lot. So guys, the main idea over here, as you can see, is that all the big boys on Wall Street haven't been participating in the selling of the crypto. They just have been looking on the sideways, probably trading these major sell-offs that we've seen from time to time. But now they understand that, the big money and the less risk is obviously to create a product related to crypto and sell this product to the customers. This is why. Nothing special over here, guys. You're not holding, you're not buying the actual crypto, you're just buying a paper, a future contract, right, that is related to a pool of cryptocurrencies. Nothing excited, in my opinion, not a financial advice, guys. You gotta be very careful what you're doing, okay? For more tips and tricks like this, subscribe and watch for more.